Most people think investing is all about picking the right stock at the right time. They believe success comes from finding hidden opportunities, following trends, or reacting quickly to market news. But in reality, there is a much deeper force quietly controlling almost everything in the financial world. That force is interest rates. And whether you notice it or not, it is already shaping your investments every single day. To understand this, imagine the entire economy as a massive system that is constantly moving. Money flows through businesses, banks, consumers, and markets like blood flowing through a body. And interest rates act like the heartbeat of that system. When the heartbeat is strong and steady, everything flows smoothly. But when it changes rhythm, the entire system adjusts. When interest rates are low, money becomes cheap. Borrowing becomes easy. Businesses take more risks, expand faster, and invest heavily in growth. Consumers also spend more because loans for homes, cars, and credit become affordable. This creates an environment where both the stock market and real estate tend to rise. Everything feels optimistic, and investors are willing to pay higher prices for future growth. But when interest rates rise, the entire environment shifts. Money becomes expensive, loans cost more. Businesses slow down expansion and focus on saving cash instead of taking risks. Consumers reduce spending because mortgages, credit cards, and financing all become more expensive. This is when the market starts to feel pressure, even if nothing seems visibly wrong at first. Now, let's break this down into the stock market. When interest rates are low, investors are comfortable paying high prices for companies because future profits are discounted at a lower rate. Growth stocks, especially in the technology sector, tend to perform extremely well in this environment. Companies can borrow cheaply, reinvest in innovation, and show rapid growth, which attracts even more investors. However, when interest rates rise, the situation changes quickly. Future earnings become less valuable in today's terms because the discount rate increases. This means investors are no longer willing to pay the same high prices for expected future growth. As a result, even strong companies can see their stock prices decline, not necessarily because they are performing poorly, but because the financial environment has changed around them. Real estate reacts in a very similar way, but often even more directly. When interest rates are low, mortgage rates are low as well. This allows more people to afford homes, increasing demand in the housing market. As demand rises, home prices also increase, sometimes rapidly. Many buyers enter bidding wars, and property values rise across entire regions. But when interest rates rise, mortgage payments become significantly more expensive. Even a small increase in rates can add hundreds of dollars to monthly payments. This reduces affordability for many buyers, which slowly decreases demand. And when demand falls, the pressure on housing prices eventually follows. The change may not happen instantly, but it builds quietly over time. Bonds, often considered one of the safest investments, are also heavily affected by interest rates. When rates rise, new bonds offer higher returns, making older bonds with lower interest rates less attractive. As a result, the value of existing bonds can fall. This surprises many investors who assume bonds are always stable, but in reality they are directly tied to interest rate movements. At the center of all of this is the Federal Reserve. Their main goal is not to control the stock market or housing prices, but to manage inflation and economic stability. When inflation rises too fast, they increase interest rates to slow down spending and borrowing. When the economy slows too much, they lower rates to encourage growth and activity. However, the most important thing to understand is that financial markets do not wait for the Federal Reserve to make decisions. Instead, markets move based on expectations of what the Federal Reserve might do in the future. Even a small change in language during a Fed announcement or speech can shift billions of dollars across global markets in minutes. This is why professional investors pay so much attention to interest rate trends, inflation reports, and Federal Reserve statements. Because in today's financial world, understanding interest rates is not optional. It is essential for understanding why markets move the way they do. Now think about two types of investors. The first investor ignores interest rates completely. He focuses on short-term trends, social media hype, and emotional reactions to market movements. He often buys when excitement is high and sells when fear takes over. Over time, this leads to inconsistent results and frustration. The second investor understands interest rate cycles. He knows when money is flowing freely and when it is tightening. He does not try to predict every market move perfectly, but instead understands the environment he is investing in. This allows him to make more rational decisions, avoid emotional mistakes, and stay aligned with long-term trends. The difference between these two investors is not intelligence, it is awareness. One reacts to the market, the other understands the system behind it. And this leads to the most important lesson of all. Interest rates are not just a financial number that changes in the background. They are one of the most powerful forces shaping the entire economy. They influence stock valuations, real estate prices, bond markets, business growth, and even investor psychology. So the next time you hear that interest rates have changed or that the Federal Reserve is making a policy shift, do not ignore it. Because even if it seems small, it is quietly reshaping the entire investment landscape around you. In investing, the biggest advantage does not come from predicting the future. It comes from understanding the forces that are already shaping it. And interest rates are one of those forces that you simply cannot afford to overlook.